you just finished your tax return or you got it back from your accountant and you're trying to understand what's going on with your tax return, and maybe you're feeling like, hey, I'm missing tax planning opportunities each year. I feel like there's something more that I can be doing either to reduce my tax in my current year or over my lifetime. So with that, we're going to look at how to review your tax return today and specifically look for common tax planning opportunities. With that, let's jump into it. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and today we're going to look at reviewing a tax return. So let's go over to a computer here and take a look at Susie and Gabe Sample. So Susie and Gabe Sample are both married. They're going to file as married filing jointly. Oftentimes it does not make sense to do married filing separately unless there's significant healthcare expenses or student loans going on. It's rare for people to file separately when they're married, or maybe there's concern about financial reporting and one spouse not reporting all the details. So they're going to be married filing jointly. They're also over age 65, so you see this box checked here. So that's going to get them a slightly higher standard deduction. They don't have enough in itemized deductions to make it worthwhile to itemize, so they are going to take that standard deduction. We'll go over that down below. But the first thing to know here is Susie is working part-time. She's sort of phasing into retirement. So she has about $30,000 worth of wages for the prior year. And with that, if she does plan on working next year, she'll want to make sure that she's taking advantage of any benefits provided through her employer. So if she has access to a 401k plan, does it make sense to contribute for them? And if so, does it make sense to contribute to the traditional side or the Roth 401k side? If they're still getting health insurance through their employer, does it make sense to contribute to a plan that makes them eligible for an HSA and make those contributions and potentially invest that for growth and be able to take tax-free withdrawals later on in retirement for healthcare expenses? So there's just opportunities through the employer plan that they want to make sure that they're taking advantage of that if they're continuing on. We're going to jump down to line 2 and skip some of these other income sources just because they're less likely for a lot of folks to come into play. But in this case, tax exempt interest. So generally this is municipal bonds. You can see that they owned some last year and earned $5,000 in tax exempt interest. Their total taxable interest was about $20,000. So the question when you start to look at taxable interest with this line here is, do they have enough in cash currently or do they have too much? Sometimes I meet families that they have a ton of money in cash and they're earning too much in interest, and maybe that money would be better deployed elsewhere where it would be more tax efficient and potentially earn more. Or maybe they have too much money at a bank. Maybe they're not earning enough interest. They're still at a brick and mortar bank that perhaps they're earning 0.01%. An online savings account or another institution would offer a much higher rate. I've seen that over the last few years. So just scrutinize this number and figure out where cash is being held. And you can go to line or to Schedule B and look at the interest here to see how many institutions are there. Maybe it makes sense to consolidate if you have 8 different bank accounts out there. Is that really needed? Is that the best thing for you and your family if something happens to you? So jumping back here, looking at line 3, we can look at qualified and ordinary dividends here and see qualified dividends generally receive better tax treatment than ordinary dividends. Qualified dividends are generally taxed at long-term capital gains rate. For a lot of folks, that's at 15%, whereas the ordinary dividends, they're going to be taxed at ordinary income rates. So you just want to see how is the tax efficiency of the investments I'm holding. And this could be holding corporate bonds or something that has ordinary income inside of a mutual fund or an ETF that's being taxed as ordinary income in a brokerage account. Maybe it makes sense to hold those bonds there, or maybe it doesn't. Maybe using asset location, it makes sense to have those somewhere else, or you have different types of investments that are spinning off ordinary dividends that aren't ideal. So that's just something to look at and say, hey, are my investments working as tax efficiently as possible in the types of accounts that they're in? But being mindful that if you do make some changes, does it make sense to recognize those capital gains if there are any? Moving forward, looking at IRA distributions, you can see their total IRA distribution matches their taxable amount here. So if you had any sort of cost basis in the IRA or something like that, these potentially may not match. And if you do have a cost basis in an IRA and you recognize some income and those do match, perhaps you're not actually picking up that cost basis. Something else for folks that are over 70 and a half who are eligible for qualified charitable distributions, or QCDs for short. If you're trying to make donations to charity, you can make those via an IRA once you're 70 and a half, but the custodian isn't going to report that any differently to you. So you need to make sure that that's getting picked up on the tax return. So for example, let's say you distributed $50,000, but $5,000 of that went to charity. At that point, maybe 45,000 goes in that 4B line, and you're notating QCD there as an example, just to pick up that qualified charitable distribution so it's not taxable to you. And if you're not aware of qualified charitable distributions, potentially it's time to research that to figure out how you can give to charity more tax efficiently. Susie and Gabe Sample don't have any pensions. They didn't buy an annuity, so there's nothing going on that figure here, but they have started to collect Social Security benefits. They both collected about $60,000 combined last year, but you'll see the taxable amount is less. Social Security is up to 85% taxable. Some people, if they have low enough income, Social Security can actually be 0% taxable or somewhere in between. And that is a planning opportunity, particularly for folks in early retirement. If income is low enough, Social Security potentially could not be taxable at all. And then you have a choice there of, do I want to recognize income purposefully and maybe raise my Social Security benefit taxation because I'm worried about higher tax rates later, either on the federal or state level, or do I want to keep that purposefully low to defer those taxes? I can't say for certain what it is for you, and that's why it's really important to run a tax projection over your lifetime to see what income could look like if you plan on moving states, once you have required minimum distributions, once you get older, once you're collecting maybe full Social Security benefits or pensions or other income sources that could come later. And I'm talking a lot about federal taxation here, but it's also important to pay attention to state taxation and what that means. And I've done videos on that before of, if you're in a low income tax state now, or maybe they don't tax retirement income and you could do Roth conversions, and you're moving to a state that would tax retirement income, does it make sense to recognize some of that income now? Can't say for certain, but it's something to be aware of. And then looking at line 7, capital gains, they had $35,000, last year for that, and we can check out Schedule D. I didn't fill this out, but it's worth looking at your tax return. Did you have short-term capital gains? Could you have held something longer prior to selling it? What did your long-term capital gains look like? And really importantly, line 13, looking at capital gain distributions, did any of your investments push out capital gains for you? Is it tax inefficient? Do you want those capital gain distributions? A lot of times you don't. You want to control how much is being pushed out of an investment and when you're recognizing that income, because it allows for better tax planning. If you have capital gain distributions, that could imply net outflows from the fund or a lot of turnover within the fund. So just paying attention to the types of investments you're holding and what sort of forced taxation it's imposing on you. If you have some long-term capital loss carryover, is that coming? So if you did things like tax loss harvesting in the past, or maybe you're not aware of that, and now is a good opportunity to do that if markets are fluctuating, and making sure that that gets carried forward. They didn't in this case, they just had some long-term capital gain distributions. So you could see their total income came to about $226,000. And then line 11, the adjusted gross income, is a really important figure because this is going to determine things like IRMA for Medicare premiums, or the healthcare premium tax credit if you have health insurance through an exchange, and any help or support you're getting for those in terms of premium credits. And then in terms of the standard deduction, I mentioned this earlier, they're both over 65, so they were taking the standard deduction, and that brings you to the taxable income of $193,700. Turns out their tax is just shy of $30,000. With that, Susie did have some money withheld from her income on her W-2, and then Form 1099, they did have some money withheld from that. So for the IRA distributions, they had some money withheld, but not a ton. And they did make an estimated tax payment of $4,000, and then they forgot. They just said, hey, I don't know if I necessarily need to make these estimated tax payments. So they didn't make it. So you can see there's going to be a heavy shortfall. They made $12,000 or paid in $12,000 for their tax, but they owe $29,570. So they're going to be short quite a bit that they owe. Fortunately, in the prior year, they didn't make very much income and didn't owe a lot in tax. So they were actually covered from a safe harbor perspective for the prior year. And you can see that's why they don't owe any estimated tax penalty. But going forward, there's something that they'll want to watch really closely because of that. If they're underpaid this much, it can hurt them. One way around not owing penalties with this is a safe harbor rule, meaning you pay 90% of your current year tax, which is a lot harder to estimate for a lot of folks because they're not quite sure where their income is going to fall, or 100% of your prior year tax if your AGI is under $150,000, or 110% of your prior year tax if your AGI is above $150,000. So for them, if their total tax this year is $29,570, they're going to want to make sure that they pay in 110% of the prior year. And since they don't have a lot of opportunities to withhold money, they might want to make equal estimated tax payments throughout the year. That's something for them to consider going forward. Let's take a closer look at Susie and Gabe's sample and how their tax situation turned out for last year, just so you have a better understanding of where they're being taxed and for tax planning opportunities. So we can see here with their total income of $226,000 and their taxable income of $193,700, that puts them in the 22% federal marginal tax bracket, effective rate of all their income about 15.3. And when we look at how they're being taxed, we can see the tax on ordinary income and what they paid, so almost $23,000, and then the tax on the long-term capital gains, what they paid in terms of those taxes. They are being taxed at different rates, so that's just important to keep in mind. As we scroll down here, we can see the progressive nature of our tax system, where the first $23,200 paying tax at a 10% rate, so the total tax on that income, the next rate here, and then where they are within the 22% tax bracket. You can see they had income about $148,000 for ordinary income, so they've still got about $50,000 give or take within that 22% tax bracket. So this might be a question for them of, do they want to consider a Roth conversion right now? Given their income, given their future income, given whatever states that they plan on living in, does it make sense to purposefully recognize some income within that bracket and maybe fill up the 22% tax bracket, even potentially looking at the 24% tax bracket if they want to do a larger Roth conversion? Perhaps they're concerned about one of them passing away earlier, maybe having similar levels of income, and then brackets compress for single filers. So that could be an opportunity looking at the Roth conversions. We can see with the long-term capital gains, they're very squarely in the 15% tax bracket, so they don't have any opportunities within the 0% tax bracket to recognize income, but perhaps they have friends that they can make aware of that. And then we can scroll down and see that given their income, their Medicare Part B premiums and Part D premiums for 2026 are estimated to be higher just because their modified adjusted gross income is going into that second tax bracket for Medicare premiums. So you can see what the estimated premium for that would be for Part B, and then the additional amount for Part D. So if they did do a Roth conversion, they just want to weigh, does it make sense to do a larger one and bump up their Medicare premium or not? In a lot of calculations that I do, oftentimes this is an adjustment of roughly 1% of a tax rate. So for example, if they're converting at 22% and the effective rate, let's say it's 22% is for ease of use, it might bump that to 23% if we factor in that additional premium. I know from a cash flow perspective, a lot of people find it very painful to pay an additional premium, but if you consider it an additional tax that you're factoring in with your federal taxes, it's often not as burdensome as people make it out to be, but it is something to be aware of. So those are the primary things I wanted to talk through when we talk about tax planning and seeing how the income falls. It's really important for them to be proactive with this. So they want to pay attention to the current year, what they can do. After the fact, it's nice to look at just to see how things happened, but a lot of times you'll miss those opportunities if you're not doing that current year tax projection. So Susie and Gabe's sample should be looking at this to see what opportunities they have available and what rate of tax and what amount of tax they're willing to pay for the current year. Hopefully you found this video helpful. Please let me know in the comments down below, what tax planning opportunities did you learn about in this video that you might implement in your life? Thanks for watching.